Why do we like to sell Iron Condors on tradeforprofits.com? Simple. It's a great way with a high probability to trade non-directional options. We have easy rules we can apply to them, which helps reduce our stress. We trade two primary types of Iron Condors. Today we're going to discuss the index option trades. Using this strategy, we primarily trade the SPX index. We do this because we have found that it moves in a more consistent manner than the RUT or the NDX index. They seem to have wilder swings from day to day than the SPX. We have found the SPX to be easier to trade long term. What is an Iron Condor? As we stated earlier, it is a direction neutral trade. Ideally, you want the price of the security to stay between your short call and your short put for maximum profit. Your long call and your long put serve to cap the risk on the trade. You can get an idea from the graphic to the left of what an Iron Condor looks like. Iron Condors have a defined risk and a defined profit, which is another reason we like these types of trades. Your max profit is the credit you get when you initially sell the Iron Condor. Your max loss can be determined by subtracting the distance between the short strike and the long strike of either your calls or your puts, whichever is larger, and subtracting the credit that you received. How do you make money with your Iron Condor? First of all, you make money every day that goes by as long as the security is priced between your short call and your short put. This is the benefit of time decay on your position. Because you're basing your trade on probabilities that the security will stay between certain price points, you're making money as long as it stays within those price points. You also make money as volatility goes down. Rising volatility can, in the short term, hurt your position, but long term, time decay will take care of that for you. We told you in the beginning there would be rules. The first one is the delta on your short call and your short put should be around 10. The second one is you need about 49 to 62 days until expiration. This gives you the best time range for time decay to make your position profitable. It is also very nice to see clear support and resistance areas on the chart. It's not a necessity, but it certainly makes you feel better when you enter the trade. As stated earlier, we just make these trades on indexes, and we prefer the SPX. We also try to get about a 12% credit when we open the trade. That means if you're risking $2,500, you want to try to get a credit of about $300. Entering on days when volatility is spiking will also enable you to get a higher premium for the options you're selling. When should you adjust your Iron Condor? The most important thing we look at is the delta of the short positions. If the short call or the short puts gets to about a delta 30, we start thinking about an adjustment at that time. Next, if the price of whichever index you're trading gets too close to your shorts. It's hard to give you an exact number on that because it does make a difference depending on if you're trading SPX, NDX, or RUT. With SPX, if it gets to within about 50 of our short call, we start to look very closely at it. On the short put side, it's probably around 75 when we really start to look at it. You also have to take in consideration how much time is left till the options expire. You can also consider what the chart itself is looking like, although we do base a lot of our adjustments on the actual price and the deltas. The next question you probably have is how do we adjust our index-based Iron Condors? You adjust by either rolling them up or rolling them out. Typically we roll them out, which simply means that we are going to sell time and hopefully roll the positions further away from being in the money. We typically start looking at about 2 weeks further out, but that could go up to as much as a month depending on how volatile the market is. It is also possible you might have to adjust a position multiple times over a couple of days or a couple of weeks if the market is moving quickly in order to keep trading by the rules. When to close. This is very important in one way that our strategy differs from most. As soon as we enter the trade, we place a good to cancel order for 50% of our initial credit. So if our initial credit was $3, then we put in a good to cancel order at $1.50, and we simply wait for that to hit and we close the trade. If we enter the trade at 12%, then we'll end up with about a 6% return once it's closed. Trading involves risk. We are not suggesting that you should trade these types of trades. We provided this video strictly for educational content. Any new strategy, you should always paper trade until you're very familiar with it. And always keep in mind, it is possible to lose more money than you have invested when you trade options. We hope you enjoyed our short introduction to index-based iron condors. If you want to know more, check out our website at tradeforprofits.com or follow us on Twitter at tradeforprofits1. You can also find our books on Amazon.com. We have 3 books out right now. The 2 Watch Me Trade books are both trading journals. They show you actual trades that we were making during that time period, as well as explanation of what we were thinking. Shortcuts to Profitable Trading is a pretty good book if you're just getting into trading options. If you already have a good grasp of options trading, you may not need that book, but we still think you will enjoy both of our Watch Me Trade books.